Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. We're here today to go over your questions or topics. If you have those, please don't hesitate to chat those over. We also want to share a hot topic, which is your CPA is wrong, how it's costing you $1,500. Specifically, how your CPA is wrong about the Solo 401k tax credits. As always, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So while you chat over your questions or topics, let's go over quickly what we're going to discuss. Again, we want to discuss the Solo 401k tax credits. There's a lot of misconceptions out there that we hear from customers and their CPAs about those 401k tax credits. There's to be fair, a lot of misinformation online. So we just want to set the record straight because it is important. Ultimately, a self-employed individual can qualify for $1,500 in tax credits. So your CPA may be costing you $1,500. Are you leaving $1,500 on the table because of a simple CPA mistake? Thousands of Solo 401k owners are missing out on tax credits. So these tax credits amount to $500 per year for 3 consecutive years. That's a total of $1,500. And these are Solo 401k tax credits, not a deduction. So that's a dollar for dollar reduction in one's tax liability. Most CPAs don't know about this opportunity. So we'll go over the confused CPA scenario now. So in the confused CPA scenario that we often see is a client will explain to their CPA that they just set up a Solo 401k and ask whether they can claim the $1,500 tax credit. A common retort from the CPA is that they're not eligible because the individual is a highly compensated employee, so they don't qualify for the credit. And the client's response will also often be that they are the only employee. How can that be right? And it's not right, because all that's needed to qualify for the tax credit, right? So to set the record straight here, is that you need to be self-employed, meaning you're reporting earned self-employment income on your taxes. That could be on Schedule C, for example, if your business is taxed as a sole proprietorship, W-2 wages, if your business is taxed as an S Corp or a C Corp. Income reported on a K-1, specifically line 14 of a K-1, if your business is taxed as a partnership. So that's what demonstrates that you are self-employed. And then the other piece of the eligibility equation is that you need to not have any non-owner, non-spouse, full-time W-2 employees. So a Solo 401k is for an owner-only business. The Solo 401k plan needs to have an automatic contribution feature. And our Solo 401k plan does. So whether you have an existing Solo 401k plan that you're upgrading to our plan, or whether you're now setting up a new Solo 401k plan, your plan through us will include the required feature that makes the self-employed business eligible to claim the credit. And the confusion really stems from the fact that the Secure Act, which is what authorized these credits to encourage businesses to establish 401k plans to help solve the perceived retirement savings crisis, created 2 credits. And so individuals are often conflating those 2 credits. If you read, as I mentioned, articles online, oftentimes the author is conflating the requirements. So the Secure Act created the startup cost credit, which does require that the business have non-owner, non-spouse, what they call non-highly compensated employees who are participating in the plan, which by definition, a Solo 401k plan will not have any non-owner employees participating in the plan, because it's an owner-only plan. So certainly it is correct that a Solo 401k is not eligible for the startup cost credit, but the Secure Act created another credit, the auto contribution credit. It's also referred to as the auto-enrollment credit. It's a totally different section of the statute, has totally different requirements. And that is clear if you look at the IRS form that's used to claim the credit. If you look at the instructions to the IRS form to claim the credit, Form 8881, they have one section of the instructions that talks about the eligibility requirements for the startup cost credit, then another section of the instructions that talks about the requirement the eligibility requirements for the auto contribution credit. And it's crystal clear that there's no requirement to have a non-highly compensated employee in order for the business to be eligible to claim the credit for having a solo 401k plan that includes the automatic contribution feature. So this confusion can be a real problem in the sense that it's costing self-employed individuals real money. They could be losing out on these credits, the $500 per year for 3 consecutive years. So the solution is really to understand the difference between the two credits so that one can take the steps that's needed so they can qualify. So again, it goes back to the fact that there's 2 different credits. Individuals are conflating the requirements for the startup cost credit versus the auto contribution credit. Many times CPAs, to be fair, they're familiar with traditional 401k startup credit rules, right? They may be more familiar with 401k plans that apply at a big company, right? Like a Fortune 500 company, as opposed to the rules that apply to an owner-only plan like a solo 401k. But it's really important to really just read the requirements. It is understandable in the instructions to the IRS Form 8881, which is used to claim the credit. So you got the 401k startup cost credit requires non-highly compensated employees. Now that credit would amount to up to $5,000 over 3 years. The purpose is really to offset startup costs for traditional 401k plans. So that's another point of confusion, right? Because with the auto contribution credit, it's not a function of the startup costs. So even if the startup costs are less than the amount of the credit, the individual can still claim the full credit, right? With, like, for example, with the solo 401k plan offered by my solo 401k Financial, that $1,500 credit will more than cover our fees for the first 7 years. So it vastly exceeds the actual costs to start up the plan. But that's fine, because unlike the startup cost credit, which is limited to the startup costs, the auto contribution credit is not limited to the startup costs. So the individual is going to be eligible to claim the full $1,500 in solo 401k tax credits as long as they set up a plan with the auto contribution feature and maintain that plan for 3 years. So yes, the auto contribution credit, it's that hidden gem. It's available to solo 401k owners, right? They're self-employed with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. That's what makes you eligible to set up a solo 401k plan generally. Then specifically, you need to set up a plan that includes the automatic enrollment feature, like the one offered by my solo 401k. And the legal foundation here is solid. It's the Secure Act, right? Congress wants small businesses to set up 401k plans to help solve the perceived retirement savings crisis. And again, there's no employee requirement, right? That's the big point of confusion that we're seeing from CPAs. So an owner-only plan is eligible. This is clear based on the instructions to Form 8881. And that credit is going to be significant, $500 per year for 3 consecutive years, total of $1,500. So let's go through a case study quickly. Dr. Sarah is a self-employed physician, has annual income of $300,000, sets up a solo 401k with the auto-enrollment feature in 2024. Dr. Sarah is eligible to then claim the $500 credit when she files her 2024 tax return, then again for 2 more years, as long as she maintains the plan with the auto-enrollment feature, giving her total savings of $1,500. So this works regardless of income level. As we talked about, this is a tax credit, not a tax deduction. Why this matters, right? So with a tax deduction, you first reduce the income upon which your income tax is calculated. So if you have a $500 deduction and you're in the 22% bracket, that's going to save you $110 in taxes. Whereas with a tax credit, you first determine your tax liability, then you reduce your tax liability dollar for dollar by the full $500. So you can see that tax credits are significantly more powerful than tax deductions based on that example. Why CPAs miss this opportunity? They just may not be updated on the Secure Act provisions. They may be reading some of the misinformation that's out there that's conflating the startup credit rules with the rules that apply to the auto contribution credit, right? Again, they may have more familiarity with traditional employer plans. So it's just an education issue, which is great. I mean, we love to educate. We're here every day with videos live webinars, trying to educate our community. So if you have a CPA that fits this, that's in this scenario, please don't hesitate to share this video. And if you share it really with anyone that might find it useful, that would be great. Like the video, it helps us to get the word out. We would really appreciate that. Red flags when your CPA doesn't know. You can't get any 401k credits as a solo owner. You're too highly compensated for credits. Solo 401ks don't qualify for the tax credits. Again, just on unfamiliarity with these auto-enrollment features, right? These are some of the warning signs that we've seen. So again, share this information, find a specialist like my Solo 401k Financial. Review your documents, right? To see if the auto contribution, the auto-enrollment features have been selected. If not, you can restate your plan to our plan, and then we'll automatically include those features. All right, let's go to the questions. We really appreciate you taking the time to join and ask questions. So we want to go through that. Do I have to have my contributions listed on my W-2? My tax preparer won't add my contributions because they're not listed on my W-2. Well, it depends. Employer contributions are not listed on the W-2. Voluntary after-tax contributions are not listed on the W-2. So pre-tax or Roth employee contributions for a business is taxed as an S Corp or a C Corp, where the individual receives compensation as a W-2. Yes, those contributions are listed on the W-2. So one option would be to go back to the W-2 provider and have them just amend the W-2 to list the contributions accordingly. Others have taken the step to report the contributions on line 16 of Schedule 1 of their 1040. Obviously, you can't put the contributions in both places. That would be double counting the contributions. But that could be an alternative that others at least have pursued instead of reporting the contributions on the W-2, line 16 of Schedule 1 of the 1040, which is where, for example, sole proprietors report pre-tax employee contributions. I see. You had to have the payroll service amend your W-2, so that's what you ended up doing. And that's fine. As I mentioned, that's an option. Thank you so much for the good participation and bringing that scenario and question to us. We appreciate that. How much do I need to max out my 401k mega backdoor Roth? Well, that's a great question. Let's answer it in simple terms. So you can contribute 100% dollar for dollar of your self-employment compensation up to the overall limit as a voluntary after-tax contribution, assuming that you have a plan like the one offered by my Solo 401k Financial that allows for voluntary after-tax contributions. So let's, for example, say that your business is taxed as an S Corp and you only want to make mega backdoor Roth contributions. So you could skip the employee contributions. You could skip the employer contributions. You could just make voluntary after-tax contributions. And that voluntary after-tax contribution limit is 100% of your W-2 wages that you receive from the S Corp, from your business tax as an S Corp, dollar for dollar up to $70,000. So if you have $70,000 of W-2 wages from your self-employed business tax as an S Corp, you have a solo 401k plan that allows for voluntary after-tax contributions, you can contribute 100%, the full $70,000 to the voluntary after-tax solo 401k sub account. Then you want to move the money from the voluntary after-tax solo 401k sub account to either a Roth solo 401k sub account, again, assuming you have a plan like ours that allows for that transfer, or to a Roth IRA. In either case, that is going to be reportable. So the first step when you make the voluntary after-tax contribution, that doesn't need to be reported on the personal tax return or the business tax return, or in the case of a person that receives W-2 wages from their business, it doesn't need to be reported on the W-2. Per those W-2 instructions, voluntary after-tax contributions, it's optional whether to report those on the W-2. So the contribution, the first step is not reportable. It doesn't need to be reported. The second step, to move the money from the after-tax account to either the Roth Solo 401k or Roth IRA, that does need to be reported on a Form 1099-R. And we handle that as an optional free service for our customers. They just need to let us know about that transfer in a timely fashion. And they can easily do it on our website. We have an online form that they can access 24/7. You can access it easily at mysolo401k.net/forms. That's how we capture the information that's needed to prepare the 1099-R. Now, we've got a wealth of information on our website. And we talk about, if you go to our YouTube channel as well, we talk about the magic number. So if you go to YouTube and you search for My Solo 401k Financial, you can easily find our channel. And you'll search for our videos for magic number. And that'll bring up our videos that are specifically discussing the magic number. And what we mean by magic number is how much income do we need in order to be able to make contributions. I was going to try to pull up one of those magic number videos. If you have more questions or topics that you'd like to discuss, please don't hesitate to chat it over, whether on this topic or even their unrelated topics. All right, I'm getting into the library here. Magic number. Oh, gotta spell it correctly. Okay, so we got one for sole proprietor. We'll open that one. And it's one of our live videos. Okay, we got one for S Corps. We got one for partnerships. So here's the YouTube video where we talk about sole props. Here's the one for S Corps. Here's the one for partnerships. Great question. Hopefully that helps. What documentation can I use to educate my CPA about this tax credit? And also I need to report all contributions to you. So let's take the second one first. So contributions are not reportable by the plan, right? Contrast this with an IRA where the IRA provider needs to report the contributions on a 5498. That form 5498 doesn't apply to a 401k. It can't even file it, even if it wanted to. So no, contributions are not reportable by the plan. So that means customers don't need to let us know about contributions. Now, they oftentimes have questions, and we're very hands-on in answering questions every day about the contribution rules. For example, how much they can contribute based on the scenario presented. Now, as far as the tax credit, we've got some good information on our website that could be super helpful. Let me grab one of our pillar pages here. Please take a look at that page. Great questions. So again, if you're finding this to be helpful, please like this video. Please share it with others. Please subscribe to our channel. Whether you're on Instagram or on LinkedIn or X or YouTube. And then you'll get notifications of when we go live. We go live every day. You can come and hear the topics that we like to share. You can come and ask questions, see what other folks are asking. So it looks like that might take us at the end. We'll give it one more moment. So while we're giving that one more moment, we have the largest community of solopreneurs, self-directed investors around solo 401k plans, over 30,000 members. So that means we've got vibrant forums. We have a library of videos and webinars. So we invite you to our community, which you can easily join at mysolo401k.net/my community. It's totally free to join. All are welcome. So it's a great way to just learn and share the knowledge. All right, everyone. Thank you so much for the good participation. Until next time, take care.